I'm University of Illinois Extension's Todd Gleason. Thank you for joining us for this FarmDoc Daily webinar, our final look at the crop insurance and commodity title choices, given the conflict in Ukraine and across the supply chain, I suppose, as well. Gary Schnitkey is with us today, Bruce Sherrick and Nick Paulson. They'll run us through a whole series of topics, including that Ukraine-Russia conflict, some budgets for corn and soybeans, the commodity choices you'll be making, and of course, we'll be talking about crop insurance as well. We do have a very quick poll that we'd like to get started in just a moment, but I want to remind you that will be that our underwriters for the day include the TIAA Center for Farmland Research. That's at farmland.illinois.edu. Bruce Sherrick is the director there. You'll be hearing from him tonight. You can fill this poll out while I'm going through the rest of these. Compere Financial is one of our supporters, along with Corteva AgriScience, Farm Credit Illinois, FS Growmark, the Illinois Corn Growers Association, and the Illinois Soybean Association. So here's our poll. If you've not started yet, please fill this out. What do you think a gallon of diesel fuel will cost by the time we get to harvest? Select one of the following: less than $3.50 a gallon, $3.50 to $4, $4 to $4.50, $4.50 to $5, or over $5. About 70. Well, look at that. Nearly 80% of you guys are really hot on putting your votes in. About 80% of you have put your votes in, and the bulk of you say it's going to be pretty high priced, somewhere above $4 and probably above $4.50. So that's just kind of a quick look at how you're feeling. However, Nick Paulson is here to talk about some of the prices of fuel and other things as we move through this webinar. Nick, thank you for being with us. Nick, of course, is an agricultural economist on the Urbana-Champaign campus of the U of I. Nick, good evening to you.
Good evening, Todd, and thanks for the intro transition into this as always. So pretty pessimistic view of where fuel prices are headed by harvest. Obviously, fuel prices have been going nowhere but up recently. Haven't quite yet hit, in terms of weekly averages, some of the levels we saw in the 2008-2009 time period following the financial crisis. But I think today, the last couple of days, we saw daily averages across the country for unleaded at least over $4. So definitely seeing increases in fuel prices. All right, so the first thing we're going to do is maybe try to spend 10 to 15 minutes, go through this probably quicker than it deserves, but talk a little bit about the conflict between Ukraine and Russia, highlight some of the things we've already written about on FarmDoc, some things that will even be coming out this week related to wheat, corn, the impact on wheat, corn, and soybeans. And so just for a little bit of background, wanted to show some maps just to kind of get a feel for the region. And so this map, we can see Ukraine and some of the areas that Russia has moved in and either taken control or has, at least in the last few days, been advancing into some of those hatch regions there. In terms of what that looks like in terms of where agricultural commodities are grown in the Ukraine, we'll start with wheat. And you can see that wheat is really grown throughout Ukraine, with a lot of the production concentrated in at least the eastern 2/3 and southern 2/3 of the country. So some of the major production regions there also overlapping with some of the areas where the conflict is definitely occurring, and Russian forces are taking control over a lot of those areas. In terms of the region's role in the global wheat market, Russia is the #1 exporter of wheat. The U.S. and Canada are kind of there in second, and then the Ukraine is also a fairly major player in the world wheat export market. In terms of both production and export shares, this is some information that was in a FarmDoc Daily article last week. But Russia is almost 20% of world wheat exports. Ukraine another 10%, so 30% between the two countries. And so between the conflict's potential direct effect in the Ukraine and the sanctions being placed on Russia from the international community, seeing a lot of turmoil, a lot of impacts in the wheat market. And we can see that here with some of the spreads from old crop to new crop, and even the 2023 crop harvest contract for hard red winter wheat. Joe Janzen actually put out an article today on FarmDoc Daily that got published in the afternoon. There will be an email out about that, talking about the forward curves for wheat and how they're inverted and how much steeper they've become just because of the uncertainty over wheat stocks globally, the crop that's in the ground in the Ukraine and across the world, and then looking ahead at how that is impacting market. What the market is thinking about in terms of the 2022 crop that'll be harvested in the summer, and then even the 2023 crop. And the market, seems to think that the impacts of this conflict may at least be isolated to old crop and then 2020 new crop wheat. No big activity yet in terms of looking ahead to 2023. But you can see there the large spread that has developed just since the conflict started here in the last week of February. Switching to corn, if we look at where corn is produced in the Ukraine, kind of the north central region is the major area where corn is produced, but also in some of those western oblasts throughout Ukraine are also, we see where some corn is produced. The direct effects of corn are probably not nearly as large as they will be for wheat. The United States still is the dominant player in terms of global exports for corn, but you can see Ukraine's growing role in terms of corn exporters. And if we look at total shares, again, the U.S. dominates, but the Ukraine accounts for about 15% of global corn exports, and with Russia accounting for a much smaller share. But, corn and wheat are potentially substitutable feed grains, and so we'll see some indirect effects spill over to corn from the wheat market as well. We see kind of similar activity, although not as pronounced with corn spreads since the conflict began. And so old crop corn has increased substantially since that last week of February when the invasion started. Slight increase in new crop prices, but the big widening spread there between old crop and new crop on the corn side. Soybeans, so the region, Russia and Ukraine is not a big soybean producing region. They are a very major producer of sunflowers, which contributes to the global vegetable oil market. And so we don't expect there to be as big of a impact directly on soybeans. You can see that obviously the US and South America dominate the global soybean market, with Russia and the Ukraine playing relatively small roles on the soybean side of things, whether we're looking at total export levels or production and export shares. And we can see that, there arguably some impact in the markets in terms of old crop bean prices since that last week of February when the invasion began, but not really any noticeable things going on with new crop beans or for new crop plus one with the 2023 harvest contract. All right, kind of the last point that we wanted to bring up tonight, I think Gary's going to get into a little bit of this on the budget side next, is just thinking about not commodity markets directly, but thinking about some other things that affect ag, and that would be a big one would be fertilizers in terms of the role of Russia, the Ukraine, and other countries in the region, such as Belarus, in terms of supplying the world's fertilizer needs. So just put together here a comparison between where the US and Brazil source their fertilizer needs. So a couple things to point out in this chart. There's quite a few numbers, but in terms of imports as a percent of total consumption, on the nitrogen and phosphate side, the US is much less reliant on imports for those fertilizers compared with Brazil. So only 12.5% of our nitrogen needs are imported from other countries, whereas in Brazil it's 95%. And on the phosphate side, 9% is imported in the U.S., whereas Brazil imports 75% of their phosphate. Potash, both the U.S. and Brazil are very dependent on importers for potash needs. And then if we look at where those imports come from, again, I think the U.S. The prices are going to rise for fertilizers around the world, but I think the impact will be much more pronounced for a country like Brazil, who is more dependent on imports in general across all three of the macronutrients, but also more dependent directly on the region where we're seeing the conflict. So much more dependent on Russia, Belarus for their fertilizer needs than the U.S. is, who tends to import more from Canada and some other trade partners. Potash, again, I think is the big wild card here. Probably something that is not really going to impact the current crop year, but probably will have bigger impacts going into fertilizer plans for the 2023 crop, given when potash is usually sourced and applied. So with that, I think I'll pass it over to Gary, and he's going to talk about budgets and commodity program choices.
Yep. Thank you, Nick. And we're going to begin, obviously, moving closer and closer to the decisions that we have to make on March 15th, and also the decisions on our planning decisions. Just another poll for us, because we are going to do some budgets here. We're going to compare corn and soybeans. So I was wondering what people thought Midwest farmers would do because of the conflict in Ukraine and Russia. So give us a feel for where people are thinking, and we have 62% of you to vote in, and so just continue to vote, and we're about ready to close the poll. And here is the poll results. 60% of you said there's no change. 15% said slightly more corn, and 25% said slightly more soybeans. I guess that shades us more towards soybeans. Here, just some observation. The first impact of the Ukraine and Russia conflict is it did cut exports from Ukraine, and it's likely to hinder 2022 production from Ukraine. That's still up in the air, and I would never discount the resourcefulness of farmers to get in the crop, particularly Ukraine farmers who have had a history of dealing with difficult situations. Obviously, this is going to be bullish for crop prices, with the largest impact, as we've already seen, on wheat. The next input pack will be likely on corn, and corn, two reasons for that. One, wheat and corn are feed grains, so they're more substitutable for one another. And Ukraine is a major exporter of corn, 15%, and then followed by soybeans, and soybeans will likely increase as well, as we have to remember that Ukraine is a sunflower seed producer, and soybean prices are going to go up just to hold acres. The first impact from an acreage standpoint in the United States likely will be in the northern Great Plains, North and South Dakota. They will likely have the incentive to plant more spring wheat, and we'll see how much they plant, and that would likely also come and reduce their acres of corn and soybeans. So that would be the first response we would expect to see. And then winter wheat may become more prevalent in Midwest and Kansas and the Great Plains, Southern Great Plains, but we will wait and see what that looks like towards the end of the year. The second impact of this may not be bullish, so don't get overconfident here. You can build various scenarios where you see prices decline. Those price declines would usually be based on price inflation leading to recessions around the world and cuts in meat consumption. So those are those are possibilities. So we don't want to get also overconfident about the price increases that we're likely to see. However, a widespread drought or other production shortfall in the United States, particularly if it's combined with planting disruptions in the Ukraine, could lead to explosive prices. And if you think about, we're already at a low stocks to use ratio. Combine that with the Ukraine disturbance and perhaps much larger cuts in production in Ukraine, followed by a drought here, and you could see explosive prices as well. So far, what we've seen actually is both corn and soybean prices increase, and they actually have been increasing since December. Both the DEES 2022 contract and soybean November 2022 contract have been on an upward trend. You could say that part of that is due to the Ukraine situation as it began to build in the later part of January and February, and that likely had an impact on those price increases. But actually, if you look at the price increases, much of it was before the Ukraine fighting broke out. So we're still in an elevated price situation, and much of that has again happened before the fighting broke out in Ukraine. Observations on production costs. This is another hit to the supply chain, and this is going to result in differences in movements of grain. We're likely to see Russian wheat and perhaps Ukraine wheat move in different directions to countries that are more friendly to Russia, probably China and Pakistan, and other major importers of wheat will be looking for their wheat from some other source. We're also going to likely see Russian sanctions put in place, and this is going to have negative supply impacts on natural gas. 40% of Europe's natural gas comes from Russia, and there will be large incentives to reduce that amount, and that reduced amount will likely lead to imports from other areas, and that could include movements from U.S. to Europe, although the infrastructure to get that happen will be difficult to be put in place. And fertilizers as well. There's suggestions of bans on fertilizer exports, both by Russian and by sanctions from Russia. And as we've seen, that will have large impacts on both the supply and the price of fertilizers. So we've decreased, and we were toying with the idea of eliminated the chance of fertilizer price declines for 2022 crop, but this would likely lead us to expect high fertilizer prices for 2023 crops. So last time we looked at fertilizer prices, it was $1,504 for anhydrous ammonia. Again, chances of that coming down appreciably are gone, and we probably will likely see increases of that. I would further note, though, that U.S. is going to be somewhat isolated from those impacts because we import less from Russia than other places. If you're a European producer, that is going to be a much bigger deal. And also Brazilian producers, particularly given that they're the next up and likely don't have as much of their fertilizer in place, that could be a big deal if this drags on. So if you're thinking fertilizer shortages are real, and they are here, they're going to be much more real as well in Europe and Brazil. If we're looking at budgets now, we put in our current fall bids as $6 and $14, and this budget is just giving you a switching decision. So we're assuming you haven't made any pricing of grains, and we haven't bought much of the fertilizer. We priced fertilizer at high levels. We built in much higher premium for crop insurance, but we still have pretty high operator and land returns because we're putting in $6 corn price, $14 soybean price. Our operator and land returns are $458 for corn, $370 for soybeans, farmer return of $172 for corn, $84, and that favors corn, $88. So even with those high fertilizer costs in there at the prices we're looking at, we see budgets favor corn. That's for Northern Illinois. Central Illinois, same thing, favors corn, $52. Central Illinois, lower productivity land, still favors corn, $82. And Southern Illinois, still favoring corn. So as we're looking at this, we've seen corn favored actually since August when we began producing those budgets. There was a period of time here in late January and early February when that wasn't the case, but this Ukraine-Russian conflict likely causes us to favor corn. So current values still favor corn, and I know we are concerned about nitrogen supplies, and they're real concerns. I would also, again, reiterate that those concerns are going to be large and could have large ramifications in other parts of the world, Brazil, Europe, and if those do in fact turn out to be the case, we could be looking at higher corn and wheat prices here for that matter. Another point I would make, given high coverage levels on our crop insurance, given the prices where we're at, and remember we have $5.90 corn and $14.33 soybeans, we can have basically the same risk situation whether we're growing corn or soybeans if we're buying at 80 and 85% coverage levels. Those coverage levels have high premiums, but they also have pretty good protection levels as well. I would suggest that the budgets would not suggest large acreage shifts on most Illinois farms, and particularly away from corn to soybeans. We got another poll here, and we're getting ready to, and Bruce is going to go through us and bring us up to date on that March 15th crop insurance deadline, but we're interested in, by the way, this poll is different than all the others. You can click as many as you want. So I should ask Nick, which ones of those would he click? And
we can click them all. I mean,
yeah,
they're all, they all could be concerning.
Yes, they are. We were just coming up with the list here, so you can click any of one of these. I think it does also point out the riskiness of the environment. We think that it could result in higher prices, but there are also scenarios where you could have lower prices. Here's the wisdom of our audience, and we're bringing the poll up here. 60% are new Cold War, 91% inflationary pressures. Yes, we will have inflationary pressure, so 91, 70 supply chain, larger iron conflict, a bit less. Recession in the United States, only 50%, but we will see. So we're moving on into crop insurance, but before we do, just two other comments. Commodity title choice. If payments were not likely before, they're much likely not likely now, so don't sweat the details. I don't know. We've varied back and forth. I tend to say PLC for corn and wheat simply because of SCO. I actually don't believe either one of those are going to make payments, and if they do, the world has really gone away. I would suggest it does. Which one of those two you select are concerned with what risk you're most concerned with. If you are concerned with yield shortfalls, then you probably would lead to Ark County, and you again do have to have PLC if you want to use SCO. We do have higher favorable prices, but high production cost. We have high expected revenues and guarantees, and we will have higher premium cost and increased downside risk. And it does continue, as Bruce will go through now, and suggest increased risk protection and use of a high coverage level in SCL and ECL. But we'll take her over, Bruce, and take us through our crop insurance decisions for 2022.
Thanks, Gary. Good evening, everyone. We have a fairly high-paced set of materials to go through, and we'll see some of you, I understand, tomorrow at our conference in Indiana as well. We're kind of on the road right now because of the urgency of getting these decisions done by the March 15th sales closing date, which applies to the major crops in the Midwest. What I want to do in the next, I want to just give a real quick overview of crop insurance generally, and then talk through 3 of our fairly popular calculators that we provide online for free so that you can assess the different risk and the different payoff potential for different positions you have, because this is really, truly a unique year. Going first just to the crop insurance prices and volatilities. This is a very busy slide, I realize, but the top table 1 shows the changes in projected and harvest price all the way back from 2011 for both corn and soybeans. The highlighted or bolded number, if it's in the projected price line, is higher. If it's in the harvest price line, is higher. And what's remarkable, at least for the last few years, we're over $2 higher in corn. We'll talk about that in a bit, but that could turn into $400 of additional protection relative to even 2 years ago, and almost $1.30 some from last year as well. Creates some considerably expanded production protection levels. The volatility factor, again, is much higher, as Gary sort of indicated on our way through. We're just in a new era right now where there are much higher prices and much higher volatility, which results in higher insurance prices. Even if the rate were the same per dollar of liability, because we have so much more liability insurable this year, insurance bills are going to look a little bit scary, just like insurance and fuel and so on. If you look forward, though, the out years also have pretty high futures prices, so the markets are not really expecting a massive return back to like the 2020 levels. If you were to look at out year futures, you can lock in a couple more years, some fraction of production. They're good strategies for doing so without fully giving up your upside protection. But one of the things it actually does do, and again, we'll talk a little bit about this in a later slide, but I do want to point out that the current futures prices, I think last time I checked today, corn was going off at about $6.43. So if you think about that, $6.43 compared to $5.90 for projected price, we're 53 cents above the insurable price, and that insurable price was really high. This has a whole bunch of impacts, but one of the more obvious ones is that it decreases the likelihood of HPE. It decreases the likelihood that the harvest price will be below the final price. So said in a little more direct way, it increases the likelihood that there will be an additional guarantee increase for regular RP style products. Because the price is higher, the probability of it getting back below $5.90 goes down, the probability of it being higher than goes up, and we're just settling on insurability of much higher revenue. The 3 tools are organized. You can find these at our home page, Crop Insurance Decision Tool within FarmDoc or FarmDoc Daily. You have to search a little bit. You do have to go to the Tools section and then go down to the section that lets you pick. But they're organized in 3 distinct areas, and then there's 6 tools total right now. But the premium calculator is a real, truly live, plug in your characteristics and you can figure out what the different prices are for each of the products, coverage levels, option units, and so forth. The payment evaluator allows you then to say, given the characteristics of your farm, if we were to replicate the price and yield risk that are in place and calculate the likely outcomes by product, you can kind of look up the probability of getting a payment by different product, the probability of how much they'll pay, the probability of how much more they'll cost than the premium, and vice versa. And then the price distribution tool, just an always live, simple visualization tool. When you go to that, you can select your commodity and contract, and it goes and picks up the most recent market data, nearly live, nearly real time, inverts the entire complex, kind of like a Black-Scholes on steroids we like to talk about. It's just a way of taking all the market data and say, if we were to balance everyone's understanding and predictions based on the prices they're paying for options and futures, what would we think the likelihood of prices would be going forward? So I'll go through those really quickly. And again, apologize. We sort of all joked that we all had an hour's worth of content and we had to shoehorn it all in because so many decisions have to be made in the next few weeks. This is really kind of our prime time. March Madness means something different to farmers who have to get everything done. Decisions made by March 15th, essentially. Premium calculator, again, as indicated, higher projected prices lead to much higher premiums, but much higher revenue guarantees. On top of that, because you can then lock in or put one directional pricing in place, things can be marketed now. You can put in floors with options and so on. It's really important to assess the marketing and the price information that you use to manage the risk as the production year goes on. Okay, so the example I want to show, and just to make it clear, this is just an example. We have around 700 counties. We have most of the Midwestern states. Essentially, any place you grow commercial quantities of corn, you can pick a different state, pick a different county, and crop corn and soybeans. Plug in your use of trend-adjusted, and virtually everybody will answer yes there. Your on-farm characteristics, including practice, and it will calculate them when you click calculate the premiums. So again, a very busy page. Don't expect you to be able to consume it all on those of you on a cell phone in particular, this probably looks really like little dots of sand or something, but just to orient it, suppose we're looking at coverage levels all the way up to 85%, the bottom row in the table, or 80%. Enterprise, basic, and optional are the first three columns for RP. The middle four columns, the middle block is RP with HPE, and the final block to the right is yield protection. Enterprise, basic, optional within each, and the amount of revenue guaranteeable by the selection of the coverage level. So again, in Champaign, with this, roughly just about 200 bushel APH on this farm, almost $1,000 of guaranteed revenue at the 85%, dropping 5% coverage is, a fairly large $58, almost $60 difference in guaranteed revenue, but it cuts your premium in half from $31.75 down to $15. Basic, much more expensive, of course, both because the enterprise subsidy rates are higher and because the insurable risk is higher. You're insuring a single car and it's, cost when you crash as opposed to the average amount in a fleet of cars, for example. An option or it's super single, including driving into the high school's parking lot. $51.96 seems like a big number to me for crop insurance per acre for 85% coverage. But again, as a fraction of the total guaranteed revenue, maybe not. We'll kind of keep moving forward here. I do want to kind of point out that the yield risk, yield guarantee in YP as the last column instead of the revenue guarantee. So you can see how far you would have to drop. In the case farm that we look at in the payment evaluator, you can also assess the likelihood, given your farm's history, of being below 167 or 158 or 148, or that column of yield guarantees on the far right. Continuing with the Champaign County, ARP, the area county level products, just some general comments first. One, you can ensure much higher coverage levels. That's by intent, because the idea when it was being developed was an individual farm has more risk, and because there's basis risk between the farm's yield and the county, in other words, your yield may not mimic the county exactly, would need a trigger that's at a higher level of the average across all farms in the county. The premiums can get pretty steep, of course, but the payments can be really, really high given the multiple factors in the payment system. And we don't see that these are very popular, despite the fact that our models and the loss rates through time and the individual experiences are that these do tend to pay back really, really high when they pay. They just don't always pay in the year that you needed the payment. So it'd be kind of like insuring your car, and every fourth year you get a big check whether you crashed or not. Kind of my little analogy for that. Again, in the interest of time, I'll keep moving forward on these. The Evaluator tool, switching to the next one. Again, our icon is just the set of crazy spaghetti graphs of different colors. But we want to be able to then say, if you do make a particular decision, what is the consequence on your insured level, the likelihood of what we'll call tail risk, or the likelihood of falling below a particular level of revenue. And then that might help primarily make decisions on type of insurance and coverage level. Do want to point out some other things, though. Within a single county and your own APH, there can be really big differences. So this example per county may not match you exactly. You will still have to carry this in and kind of go through it on your own one at a time. And again, the thing that I find kind of amusing is when we make maps of the county level rates, it kind of looks like a Lego map. You know, county to county, there can be big differences, even though production that might be near the border of one county and another would not be considered to be differentially risky. It's just the fact of the way the ratings are built up through time lead to different rates by county. Okay, what you'll see in this, and this is, again, I'll go a little slower just for a moment, just to show what's going on. This is updated at the end of every day so that we can model with the correct distribution of prices, even though the projected price is now fixed at 590 and the volatility factor is now fixed at 0.23. Again, the same Champaign County farm. The revenue available, though, is influenced by the futures price. And again, yesterday or Friday, I guess, when this was run, or whenever we ran it last, I think it was Friday when I ran this one, the futures prices were 628. Again, they're quite a bit up from that today. So the revenue numbers would even be getting more favorable as we move forward. The case farm information has some incredibly important things here. They're very technical looking, but I'll try to just orient toward what they are. And if you need more time, maybe the specific page that corresponds to your county is easier to look at. Given the farm average and given the farm standard deviation of yield, and we've found that we've gotten reasonably good. This is not precise, of course, but reasonably good at predicting over a large number of years what one would expect the yields to actually be, so we can talk about the number of times they'll trigger. The farm yield bushel per acre, kind of in the middle right part, says 30% of the time you should expect yields below 178, 20% or 1 in 5 below 165, a 1 in 10 below 145.90, and a 1 in 20 event of 129 bushels. Now, to the right of that is the county yield associated with those same probabilities, which indicates why the area yield and individual products differ. It's harder to push the entire county yield down than it is to push a single farm's yield down. And again, this is just the left-hand tail risk. So the upside, the flip of that, if you will, 30% of the years yields might be above 220, or it's, kind of it's not symmetric, but that same idea happens. So what does that mean? Whoops. There we go. So the information is then presented in a series of tables and a series of graphs that show repeated information from the premium calculator. This is for a basic unit. Enterprise units are also available in this tool. We don't go to optional. You can kind of think of a super basic unit, and the same patterns you saw from the premium side would apply here. But let's focus on the 80% coverage. At 80% coverage level, which in this case has almost a $28 premium, the average payment would be $51.64. Now, that's a higher number than the premium because these are subsidized products, of course. So in a lot of years, you don't get a single payment, but you do get a payment that on average will be higher than the amount of farmer paid premium. The payment frequency, or 30.7 times, says about 1 in 3 years you should actually get a payment. And then the net cost in dollars per acre of being negative. When the net cost is negative, that means it pays you back. If your costs are negative, I know it's a strange accounting convention, but if your costs are negative, you get paid back more than it actually costs you. And again, we use that sign convention because not all counties and not all parts end up paying you back that much more. The average gross revenue. Now, this is something you can't get just by multiplying the price times the yield, because they're correlated. When yields go down, prices go up. When yields go up, prices go down. And it's a little more complicated, but for this acre, we would say the average revenue would be $11.65 per acre, given insurance. So that puts the crop yield and the expected price together in a probabilistic fashion, including the insurance payments and the premiums. Nets all those down, and you see that in coverage level from 50 up to 85, your gross revenue per acre numbers on average don't change that much. The tail is what really gets important. I won't spend time at the moment going to the middle and to the right in terms of explaining them one at a time. It's the same layout. RP is by far the most popular policy. Gary, we see something around 90%, in fact, of those at this point. So I think most people have essentially made their decision. Usually a year after a big summer price rally that lasts into fall, people say, I'm never buying HP again. But that's just, sometimes it's actually numerically advantage. There is a numeric advantage, but people still prefer RP. There we go. County level products, the same sort of presentation. And again, all I'll point out is that the average gross revenue that you can guarantee is actually higher with the area products. It's just the correlation between when you need a payment and when you get a payment is not nearly as high as it is with RP. I'm going to go on again in the interest of time and go to the really cool, I think, really cool and somewhat a complicated graph. A few of these coming up here, so we'll look at it. This is a hard thing to interpret at first, but for each of the products you can look at, we then say, what's the likelihood of your revenue from some low number? This one starts at 326, goes off the chart here at 1185. Of course, it's, revenues can be much higher than that, but we don't have as much interest in explaining super great outcomes. Don't seem to be the thing that we talk about when we're talking about insurance. Now, the blue line is the probability of revenue with no insurance whatsoever. So we would say there's roughly a 30% chance, if you look at the 30 percentile line on the left, it intersects the blue line just a little above 910. 30% chance. Oh, but gosh, there's, a 20% chance of being below 841 and a 10% chance of being below 704. And I would personally find that to be a pretty problematic position given the size of my bank account. If I had 1,000 acres and had put, almost $1,000 an acre into production and then got $704 of revenue back. So the rest of the lines say, how good of a job do each of the different products do in cutting off that tail risk? So what you actually want to do is move your revenue to the right. You want the lines to be shifted to the right, and you also want them to be made more steep. You want them to cut off that left-hand tail, so to speak. The RP85 in red kind of covers up another line for much of its presence on the chart. So does the corresponds to the YP85 down to the point of revenue kicking in and yield continuing to go down. So that break point around 944, where all the lines kind of looks like a highway map of the interchange of all the highways. If you think about what's being portrayed here and focus on RP85 for a minute, it says there's essentially no chance of getting revenue below about 910. Any price and yield combination that occurs, any yield and price combination that occurs, I'll say it again, guarantees revenue at least to that level. There's another nice feature of this utility that you can type in a particular target revenue that you care about, say $1,000 an acre, and then look at the probabilities of achieving that. And without insurance, and then with insurance, you can kind of compare to how much benefit you get from having that insurance. Now this is not an advertisement for insurance, but it seems rather clear, both because virtually all acres are insured and because of the incredibly important risk protection it provides that most people are going to look through, and whether literally and explicitly think about it this way or just generally think about it and pull these triggers out of their past experience. The last thing I'll say is that the two ARP and ARP HPE lines, and then the yield, the area yield, they do in fact return more than the other insurance products through time for this county and with this particular production circumstance. But they do a not great job of cutting off the tail risk. So that's the problem, is that they just don't have payments that are correlated, not nearly as correlated with the need for the revenue as the other products. Okay. One other feature, just to show, you can actually go into the chart and just drag your cursor around, and it looks very technical, but you can pull out the individual probabilities of getting to different levels by product type as you drag them around through the different areas of the graph. Okay, the next thing to look at The price distribution tool, and again, this one was run a couple days ago. Prices are up quite a bit last couple of days, partly to, as we heard, to the conflict in Ukraine, partly because markets do what they do. But what this does is picks the information out of the futures and options markets and says, given the prices people are paying for options and futures, what would be the most consistent probabilistic description of what the market participants believe the prices would be for this contract through the date of expiration. And so we can look at this and say, I'll again go forward one slide here, and look at corn at the projected price of $5.90. Again, this was on March 4th at 9:52 at night. So, right before the weekend, it took us a little while to get the slides made, so had to run these a little bit ahead of time. At that date, you put in a price to evaluate. The graph just shows the shaded area and gives you the probability of getting above or below that line split into parts. So the price at expiration and the probability graph on the right contain the same information, just tabulated differently. If we were to say what area of the curve would shade out to be 95%, we would have to go all the way up to 992 as an example, or there's a 5% chance that prices will be above 992, a 5% chance that prices will be below 362, and so on. Again, we're pretty happy with this tool. It seems to work really well through time. We've had it up and live for several years now, and it's fairly well calibrated to the market's expectations. So if you just don't want to have a quick view of what everybody's thinking at some point in time, and especially as we get a little closer to that March 15th date, to me, it makes some important information available about how to perhaps hedge in something immediately after buying crop insurance. Soybeans, 1433. Again, these aren't perfectly symmetric distributions. They're modeled as something that's a little bit more realistic to what we see in the market. And around a 50% chance, though, as of Friday, that prices would be below 1433. Again, there's kind of skewed toward the upside in both cases. So it looks like there's a better chance for things to run in that direction in terms of distance or price move. And moving on, I think we're going to have enough time for a few questions here at the end as well. But a couple of important things about planting dates and prevented plant. We all still have probably, although hopefully it's fading, we probably still have some sense of 2019 in our memory when there was a great deal of excess moisture in the spring. Had to make decisions on not planting maybe 9 million acres or so, and need to get a little bit of kind of that back in front of us just to think about it. The final planting date, the last date at which you can claim prevented plant, late planting, 20 days for corn and 25 days for soybeans, but the crop insurance goes down 1% per day. So you can continue to plant, you can continue to do what you would do as a best practice, but your amount of coverage begins to suffer as a result. After the late planting period, the insurance guarantee is 60% of the original amount. And again, these I'm actually making this sound much simpler than it is. The specific rules get a bit more complex than this, in fact. We had a set of experiences in 2019 to help clarify it. You can plant another crop for harvest, but you get your prevented plant payment cut by 65% of its original fraction if you do that. A couple of other quick points to register. The split in the state is not identical for the two crops. The June 5 and May 31 dates for corn, June 15 and June 20 for soybeans by region of the state, again, correspond to what makes sense. We kind of have zones that make sense. And again, Gary, anything else to say on this one, or just keep plugging through them? So, final slide before we move to questions. And maybe all of us kind of join back in here and have our conversation about what we think about it. But prevented plant combo product, you can get it on any of the combo, so RP, YP, or RP with HPE. You don't get it on your supplemental coverage, and you don't get it on the area of products. So that's an important consideration for many people. The payment for corn is 55% of what you would think of as your normal calculated revenue. You can buy up the extra 5% to 60%. For soybeans, 60%. You can buy up extra 5% to 65%. And there is a very popular movement in the market for non-reinsured supplemental products that allow you to move your coverages both in RP and in the prevented plant portion of the add-on insurance to having higher coverage bands, or most of them even allow some skip bands. I kind of went through this vertically instead of horizontally. Should have just given the example of payment on the top one for corn. High yield, high coverage level, 55% payment factor, 85% would give you $552 payment in that case. 441 if you were a lower yielding situation. But again, substantial, truly substantial coverage now for the prevented plant replant payments. With that, I think I'll stop, and we have had some questions come in.
We do have a couple of questions. We'll get to those in a moment, Bruce. Just a reminder that we're talking tonight with Bruce Sherrick and Gary Schnitkey, along with Nick Paulson. Drop your questions in the question box that's over on the left-hand side of the page or down at the bottom of the page, either one. We'd like to thank our partners, the educational partners for the evening's event, include the Department of Agricultural and Consumer Economics, to which all three of the folks we've been listening to belong, along with University of Illinois Extension and Illinois FBFM. Our sponsors for the FarmDoc website and other FarmDoc events include TIA, Center for Farmland Research. That's at farmland.illinois.edu. Bruce is the director there. Compeer Financial, Corteva AgriScience, Farmer Credit Illinois, Illinois Corn Growers, the FS Growmark Companies, and Illinois Soybean Association. Thanks to all of them, and we'll pop that last slide up as well, which tells you that you can pick this webinar up and review it if you'd like anytime you want. That's easy enough. Actually, you can do it from the FarmDoc Daily website. Just look under Archives for Webinars. You'll find all kinds of things there. Or you can simply go in probably 24 hours, I would think, to YouTube at youtube.com down there on the bottom of that slide, youtube.com/FarmDoc video. And one other item tomorrow, we all will be at the Beef House. At least I will be there along with Nick and Gary and Bruce. Bruce and Nick will be taking up farm policy and price of farmland and outlook. Gary will go through budgets and crop insurance, and we'll have so much more. And you can still register, though. You'll need to know the secret way to do that. Let me give you that. It's go.illinois.edu/spring outlook. We start at 7:30 a.m. Central Time. That's when we open the doors. 8:30 we kick off the meeting. Go.illinois.edu/spring outlook. The cost is $25 at the Beef House tomorrow. If you can register still and make the trip over, should be a great day. Which questions you want to pick up with? Let's start with that first one about RP-HPE. I think it's a fairly interesting question. Gary and Bruce, you want to talk about that one?
Yeah, I would just say, since the events have happened, we've seen prices go up and also volatility go up. The volatility, and you can build scenarios where you are looking at much higher prices than we're at the projected prices. All of that pushes you more towards RP rather than RP-HPE. Having said that, if you're concerned about the premium, I would, and you're thinking of going from RP-85 to RP-80, the RP-HPE 85% would keep that revenue guarantee up there, with the caveat that you don't have that guarantee increase in there.
And the thing that will cause a payment, the probabilities of price and yield combinations does change a bit. It's a pretty complicated modeling question. It's a great question. I think what Gary said is exactly right. The movement of futures prices above the PP does decrease the likelihood of HP, but it's an expensive product. It's a little bit like saying, well, now that there aren't any trucks on the lot, should I buy a Ford or a Chevy? Well, they're both much more expensive now, and they're harder to get, and it's just comparing two things that aren't the same.
So in Southern Illinois, the insurance people are talking about RP at 80% and ECO. I think that's a good policy alternative. Southern Illinois is at RP 80% because you sort of don't want to get a $50 premium on your, which would happen at RP 85. ECO will provide you this year some valuable revenue production, and that will push you up on that revenue curve. Again, I would, whatever you do, I would sort of stay at as high of RP or combo product as you can, that 80 or 85% coverage level. And both of those are going to provide you with very good revenue protection. If you're going the ECO route, you probably don't have to do much marketing more at this point. You're buying a subsidized call option on revenue, not on price, or put option on revenue, which, it's a good alternative.
I think it's a cash flow consideration in some cases because it is very, very expensive to buy all the way up. But remember that these are subsidized, so you're buying dollars for less than 100 pennies. In some sense, the idea is they're expensive because the coverage is so much higher and so much more valuable. And it's a cash flow though. So I'm not suggesting, or I'm not arguing singularly in favor of the highest coverage and the absolute Cadillac coverage of everything. But over the long term, that will generate the highest total return given the subsidy effect.
So our insurance tools on the web do not include SCO and ECO. We have covered a number of articles that have covered those on our farmdoc website. RP 85% and for that matter, those 85% coverage levels are the best way to cut off the downside revenue risk.
And that wraps up, unless somebody else has another question.
There is one question here. What was sent into us? What are the net advantages and disadvantages of 75, 80, and 85% for soybeans on RP policies? All right. I'll tell you right now, if you buy a 75 and 80% policy, you're going to have a very low premium and almost no chance of getting a payment.
Right.
And I guess
especially in Illinois, they're farther north. Those probabilities change a bit up into the.
And that's a northern and central Illinois thing. Southern Illinois, you're probably looking at that 80%. I would again tend to be on the higher end right now, just because those would be. You're having a very volatile year. You got some high projected prices out there, and we can do something to cut off some revenue risk at the bottom.
Yeah, I apologize that my metaphors are tired and silly, but I don't think that when you start driving on the Autobahn is the time you should cut back on your insurance coverage for your car either. And so right now we're in a much higher risk situation. Volatility is much higher. We're in a world circumstance where, a couple trigger events could really change prices dramatically. I don't see that the world stocks are going to fully recover either in the short term. So I understand the arguments against high coverage. And again, they're primarily on cash flow. And if you have enough reserve to manage your way through potentially a year or two of bad outcomes, then that can be a really good strategy as well. Aggressive marketing behind the RP at the prices we have now is something people are beginning to look at. I hardly ever suggest anything aggressive. I think it is important, though, to take that into account. We're at a place where you can lock in prices at a level relative to the PP that we haven't seen in many, many years. We're getting a note. We're gonna all turn into pumpkins here, and we're all going to be on the road here in another 8 or 10 hours anyhow. But if you would include in your comments what you think about an evening webinar. If this was good, if this was bad, if it fits into your time schedule better, if you'd rather have them at 6 a.m. instead, whatever the preferences are, give us a little bit of a feedback on this, because it's been an experiment for us too, to see when in the time zones of the world we should have the most audiences.
And by the way, just as we kick this back to Todd, one further comment on risk and higher coverage levels this year. I would also note the commodity title isn't going to be providing much risk protection unless things get really bad. So with that.
Thanks. With that, go to Gary Schnitkey, agricultural economist on the Urbana-Champaign campus of the University of Illinois, along with agricultural economist Nick Paulson and Bruce Sherrick, both his colleagues there in the College of Agricultural, Consumer, and Environmental Sciences. I've been Todd Gleason, your host for the evening. Jim Baltz is behind the scenes. You have a good evening, and do be sure to fill out that survey as you exit this evening. Good night.